So sometimes not everything goes according to plan, right? Life takes a sideways route. Maybe you didn't get the girl whenever you were in high school, didn't get the job that you wanted out of college, and maybe you bought a stock this year and it's down. So while not everything can be self-corrected, well, there is something that you can do with that loss in your stock. So we did want to talk about today tax loss harvesting. It is that silver lining where you can sell an investment at a loss, and you could realize that loss against any potential gains, thus limiting your tax liability.
Yeah, and this is a good strategy for either an individual stock or a stock pick, like you said, that just goes south on somebody. Yeah. Or it could be the market in general, like 2022, where all asset classes are down and it seems like everything has a loss for the year. So again, tax loss harvesting is just selling a loss and realizing that on your tax bill to help offset current other gains. It's pretty straightforward and simple.
Now, before we jump in, I did want to talk a little bit about losses. Now, USC did beat UCLA recently. And
I don't know what you're talking about.
You have no idea what you're talking about?
No. Did they play?
They did play.
Yeah, I don't remember.
Does that 48 to 45 score ring a bell?
It feels painful. It feels very painful. It was so close. We were finally doing well.
It was a good game. Yeah. Yeah. I do have some love for UCLA. That's where I went to grad school, but
as
undergrad.
Rightfully so.
So
next year, right. We'll try again.
Let's stay on task here. So
So how our first thing to understand is investment gains, and especially what we call capital gains, are taxed differently than income, right? So when people think about their ordinary income, we have these marginal brackets that we go through progressively.
Correct.
However, capital gains, and when we say capital gains, think of it like just an investment gain, right? You sell generally investments like we're talking about now in a brokerage account, but it could even be selling a house, selling a business. And those have different tax brackets. And now they're related to our income tax brackets because depending on how much ordinary income we have, that will help determine what tax bracket our capital gains are. But there's 3 brackets, which are 0%, 15%, and 20%.
Yeah. For the long term, just to be clear.
For long term.
For the long term capital gains, correct. So if you hold an investment for longer than a year, you get a break from the IRS. So it's not taxed as ordinary income. So we talked about the 0, the 15, the 20.
Yep.
Did we want to go over the short-term capital gain brackets?
Yeah.
I think in short, just keep in mind, it ranges from 10% on the low end all the way up to 37% on the high end, depending on what your ordinary income looks like.
Any investment you hold less than a year, you sell it, you have a gain. That gain is going to get taxed as if you earned it from your job. So that just gets added onto those marginal brackets. There's going to be no tax break for anything you hold under 1 year.
Right. So the idea is if you have a loss in an investment, you want to sell that loss to offset any potential gains. Now, it might be quite tempting to sell an investment at a loss. Let's say you bought a stock. Let's call it, what's a down stock this year?
Peloton. Let's go with Peloton.
Let's say you believed in Peloton earlier this year. You're like, you know what? I want to buy Peloton. I think it's an up-and-coming company. And obviously, it's down quite a bit this year. You're down on your investment. It might be very tempting to sell it and then buy it immediately back.
Yeah.
The next day or even the same day. You can buy it within a few minutes.
Yeah.
Well, the IRS is a little bit smarter than that.
They've thought that through.
They've thought that through. Yes. So they have what's called a wash sale rule. So a wash sale rule prohibits you from buying that same investment within 30 days. And if you want to realize that loss. So if you want to buy it back, you have to wait 31 days or greater.
Yes. And they apply that both before and after. So that you also can't be sneaky and say, I'm going to rebuy some Peloton here, and then I'm going to sell this chunk of shares.
Yeah.
They realize that both 30 days before and after. So they're not going to let you go and sort of swap it out and do that. So that wash sale would eliminate that ability to realize a loss in that year. But another interesting thing is crypto. So crypto is unique in that crypto, like Peloton, has been getting crushed this year. So if you are a new investor to crypto, say the past year, odds are you're down pretty heavily on your investment.
I don't know a single crypto that's up this year.
I don't think there is. Who knows?
I don't think there is one.
We'll have to look. There's
maybe
thousands.
Some random. I don't want to. Can I curse on this show?
That's a good question.
Yeah.
We can find out real fast.
Yeah. Well, if you have a random shit coin, then
you're probably,
maybe there is.
If you made the coin, you might be up.
I'm pretty confident every crypto is down.
I'm pretty sure. Yes.
So yeah, the IRS doesn't recognize crypto as an ordinary investment. They consider it an asset. Right?
Correct.
Sort
It'll
of
be taxed like property.
That's taxed as a property. Yeah.
Yes.
So the wash sale rules don't apply for crypto. So if you're down on crypto this year, you can sell it today and immediately buy it back and realize that loss and not even worry about the wash sale rules. So that's
Yes.
Could be a significant savings on your tax bill this year.
And it's certainly something to look at because the IRS has in a number of these bills we see that go to the House to see if they're going to get passed. They've oftentimes mentioned eliminating this little loophole that crypto has that avoids the wash sale rule. So there's a chance that something gets changed. There's even a chance they've talked about making it retroactive. Odds of that seem pretty low.
Just seems very unfair, though.
If I were a crypto holder and I had a big loss, I would definitely be looking at doing some tax loss harvesting with crypto for sure this year, because who knows what the future holds. Because again, you don't have that 30-day before and after window as of right now.
Yes.
Yeah. So that's a good one to look at.
Yeah. So let's talk about some rules of thumb when it comes to tax loss harvesting. So we want to organize it from short-term to long-term. So let's begin with short-term first.
Yeah.
Let's say you have a short-term loss.
Yeah. So the real order operations, right? If you have a short-term loss, that first is going to look at other short-term gains for that year, that calendar year.
Yeah.
And so if there's no short-term gains, then that short-term loss will look at are there long-term gains?
And again, applied against that.
It'll be applied against that first. And if there's none of that, then basically the IRS looks at long-term losses that you've realized. That'll look at long-term gains first, and then it'll look at offsetting short-term gains after that. And then once those have netted out, if there are no gains, then you can take up to $3,000 and apply that to ordinary income.
Yep.
And so that's one of the real benefits as well of tax loss harvesting, is trying to realize it against income. Because for many people, their ordinary income rate is higher than their capital gains rate. So getting to use $3,000 to offset ordinary income is basically a tax arbitrage where I get a better benefit, more bang for my buck on this tax savings.
Now, let's say you have a lot of losses that you can't apply it to any gains this year, and you've already met that $3,000 ordinary income write-off. What can you do with that? I'm trying to tee you up here.
That will carry over. That will carry over, right? So let's give an example, right? Okay. So let's give a real life example.
Yes.
Let's take two ETFs that are international ETFs. International has struggled the past 10 odd years. So a lot of people, a lot of people even that have had a long-term holding, it's been a rough time investing internationally, right? We've seen that. Yeah. So two ETFs that are both by one same provider, right?
iShares. Yep.
From iShares. We have the ticker EFA and then the ticker IEFA.
Yep.
And these both are developed international, right?
Correct. Yep. Developed international. So EFA is an ETF that basically tracks the large and mid cap developed market index, whereas IEFA is the large, mid, and small developed index. Okay. So if you were to look at these two ETFs and track them on top of each other, they basically move in sync. Like there's very, very little deviation from each other.
Yes. Past 5 years of performance, 0.03% difference of overall performance the past 5 years. That's identical.
But they're technically different funds. Correct. Where one fund holds about 800 individual stocks, that's EFA, whereas IEFA holds, how many was it? 3,060?
3,060.
Yeah, yes. 3,060. So there is a big difference between the overall strategy.
Yes.
So let's say you bought EFA at $20 a share, and let's say you're down and you're able to sell it at $15 a share, realizing that $5,000 loss this year.
So you put 20 grand in, it's now worth 15. You sell it, you've got a $5,000 loss.
Correct.
Yeah.
Yep. So you got a $5,000 loss and you wanted to buy IEFA in its place.
Okay. So now you invest $15,000 into IEFA.
Correct.
Okay.
Now you can use that $5,000 loss as a God, what am I trying to say?
Like a long-term capital loss.
I can't speak today.
It's going to be a long-term capital loss. And now if you have the beauty of tax loss harvesting is, remember, it's going to now take that $5,000 loss and it's going to look at, do you have any other gains for the year? It's going to look at long-term gains, short-term gains. These are all going to offset. In this example, we'll say there are no other gains, right? It's 2022. You've not sold anything that's got a gain. Loss. This is just the only thing you're selling for tax purposes.
Yeah. And
now you've got a $5,000 loss. You can use that to offset $3,000 of ordinary income. Mm-hmm. Now we still have this $2,000 left over. That carries over into next year. And in the next year, that same netting process happens. That $2,000 will look at short-term gains, long-term gains, offset those. And if there are none, then once again, you can use up to $3,000 to offset ordinary income. In this example, we only have 2 left over,
Right.
but you can extrapolate that to your own situation to look at your account and say, do I have anything that's a big loss?
Yeah, and we've seen that with a number of clients where the numbers are pretty large. Where we have a client who has maybe a couple $100,000 worth of losses.
Mm-hmm.
Might as well just sell those at a loss. In this client's case, it was crypto losses. Might as well sell that crypto at a loss. There are no gains this year, which it needs to be really applied to. And the idea is like, yeah, you don't have any gains that you need to offset that with this year, but you can carry that forward into next year.
Yeah.
If there are no gains next year, carry that forward into the year after that.
Yeah.
And so it's just this great loss liability, but it's not really a liability. It's more of an asset to where it really can benefit you in the future if you ever do have a big tax year.
Yeah, and it's a good thing to look at too for people oftentimes feel stuck in their portfolio in terms of, I don't want to sell this. I've got a gain on it. This really helps you look at, do you have a concentrated position somewhere else that you can offset some of that gain? Yeah. And it's a chance to look at your portfolio and go, okay, do I do like a reset? Do I need to do a portfolio makeover here? And can I get away with more changes because I've got losses that I can do? And again, since they carry over, it's really huge. And one other thing to note when we share those 2 ETFs, it's important to look at that, right? Because again, that wash sale rule, what you don't want to do is take an ETF and say you're tracking the S&P 500 with a Vanguard VOO and then just go buy the iShares IVV. Those track the same index. So
they have the same holdings, same everything.
Spot on. So the IRS considers that wash sale rule anything that's substantially identical. Now, in the IRS's wisdom, they don't give you a true definition of what substantially identical means.
Wisdom.
So it's really easy to go, hey, I can't sell Apple and buy it back and realize the loss.
Right.
ETFs and mutual funds get a little bit trickier. So that's why we shared 2 examples. You should go through, look at ETFs and go, hey, these have similar performance, but they track a different index. Or like we shared, IEFA having basically 2,500 more companies than EFA. That's clearly not substantially identical.
It's a different benchmark.
Different index.
Yeah.
So you're able to still capture those future gains, or if you want to call it a potential rebound, by staying invested, but realize that loss.
Yeah. And a lot of managers and investors will not only do it for funds, but they'll do it for individual stocks. So let's say that they have a certain allocation within each sector. And let's say that within the energy sector, let's say that they own ExxonMobil, and let's say that their investment happens to be down from whenever they purchased it. So they might sell that at a loss, but then they might buy Chevron in its place. So they're going to get, the same beta exposure within the same sector, but it's going to be a completely different holding. So you'll see a lot of managers use the tax loss harvesting for individual stocks in that capacity as well.
Yeah, absolutely. Thinking, hey, if this sector does well, if something economically is going on, all of these companies in the same sector are going to benefit.
Like these. Yeah, exactly.
Yeah, that makes sense. So when would tax loss harvesting have some great benefits? When does it not make sense? When do you feel like somebody shouldn't pursue tax loss harvesting?
The first one, if there is no better alternative to buy.
Okay.
Right. So an example is going to be the S&P 500. Like, let's say you happen to own VOO, which is the S&P 500 Vanguard index fund itself. It doesn't make sense for you to sell that if it happens to be at a loss, if there is no better alternative. And chances are, well, if it's not chances are, it should be a core holding of your portfolio. So if it's down, it doesn't make sense to sell it and try to realize that loss, because there really is no better alternative for a core holding like that. So that should be rule number 1.
Okay.
Right? Don't sell something if there is no better alternative to replace it with.
Okay. Yep. Another one that's commonly misunderstood is there is a potential for realizing long-term capital gains at a 0% capital gains bracket. Like we mentioned, those 3 brackets, there's 0%, 15, and 20.
Yep.
So if your ordinary income is in the 10 to 12% brackets, you will be in the 0% capital gains bracket.
Correct.
Now, that doesn't mean that all of your capital gains are 0%, but certainly some of them might be. And so that's a great time where you wouldn't want to tax loss harvest. You would want to do the opposite. You would want to tax gain harvest and sell things that have a gain, because you'd pay a 0% federal capital gains rate. So that's one time for sure. If you're in the 10, 12% bracket, take a close look at where you are. And you don't necessarily want to sell losses. You want to realize gains.
Because it's a very small cost to get out of those positions or trim that position or whatever situation you might be in. Right.
Absolutely.
And the last one is going to be, this only applies to taxable accounts. So if you have any losses in a tax deferred or tax-free account, like an IRA or a Roth IRA, obviously this strategy does not apply, because there is no tax liability within those accounts.
Yep. Absolutely. So, you're not going to get any benefit. And I think though that does tie in another topic, which is important of it's not just the activity in your one brokerage account. So your taxable account. So when it comes to wash sales, et cetera, you can't go and buy something in your IRA and sell it in your brokerage and realize that loss in your brokerage.
Correct.
So the IRS has thought about all these strategies you might be thinking about right now. What can I do to eke a little bit more out of this? So just be aware that they look at all of these accounts as one entity. So you can't buy in one, sell in another, and avoid the wash sale.
Yes. Like an old mentor used to tell me, so there's 2 general rules in life. You want to make your spouse very happy and don't mess with the IRS.
Those are good rules.
Taxes.
I think that's
you can be tax smart, but pay your taxes.
I think that's the perfect ending right there. Spot on.
So we do appreciate your time. If you do have any questions, feel free to reach out to us. We're happy to respond to them, whether it's in the comments or you send us an email directly. If you want to find some more resources, head over to our website, which is thewealthfix.com, and we'll leave it with fight on. See you later.
Why?